Good morning, everybody. My name is Cameron Joyce. I'm a member of the Research Insights team at Preqin in London. And it's a pleasure to be able to speak with you today. Thank you for taking the time to join this presentation. First of all, we're going to look at the alternatives investment industry in Latin America. But before we do that, I'm going to run over a few things about our most recent data points that we've seen across the global market as well, some of which we've published in our Q1 update that was released this week. So without further ado, for those of you who are less familiar with Preqin, we are a data research and insights provider for the alternatives assets industry. We have over 300 research professionals working across the globe in various markets that you can see there. We have several offices around the globe. Our LATAM coverage is comparatively new. We have a dedicated Latin America research team based in New York. No Latin America presence as of yet, but at this rate, there's a good chance that we'll open an office before too long. But that's our footprint. We collect data from GPs, LPs. We cover everything from fundraising, deals, exits, funds in markets, and also performance and much more through our Preqin Pro platform. So I'll move on to the agenda for today. So first of all, we'll have a quick overview of what's happening in the global industry before taking a look at what LP appetite is like for emerging markets. Then we'll go into Latin America and Colombia as well. So firstly, I think everyone's obviously aware of what happened most recently with the markets last year. We obviously saw a very strong sell-off in risk assets in the first quarter, but then an equally remarkable recovery in risk assets, including alternatives as well. Now, clearly, a lot of that recovery and the strength of the recovery was down to a lot of fiscal, monetary, and other forms of stimulus, including the Fed's willingness to intervene in the corporate bond market, which helped alleviate any potential concerns that were building there. Now, AUM, these figures are actually put together in a report that we did last year, our Future of Alternatives 2025 campaign. We're projecting that AUM by 2025 is going to reach 17 trillion across alternative assets. Now, if you look at the growth overall, it's pretty much in line with what we've seen in the past, but actually the composition of this growth is changing quite a lot in terms of the geographies of where we expect the growth to come from, but also the asset classes within alternatives that we expect to perform and other asset classes we don't expect to perform as well. Private equity, as we'll see later, is the strongest asset class, the strongest growth that we expect from any asset class, and a lot of that is underpinned by the assumption that we're going to continue with lower long-term government bond yields. Now, that's something that obviously has been on the increase in recent times, but we expect long-term inflation expectations to remain anchored, and that should support the ongoing rotation that institutional investors are having into alternative assets. Now, the fundraising picture is an interesting one because we've clearly seen a peak in the fundraising cycle going back to 2017. This coincided with a period of time when the aggregate amount of investor cash flows coming from private equity investments in particular turned negative. And this is quite normal as part of the private equity cycle, but that instigated a slowdown in fundraising, certainly in terms of the number of funds closed. And that's across private capital as a whole. However, if you look at the aggregate amount of capital raised, that's held up comparatively well. And we can see here that we've had quite a few years now of fundraising for private capital as a whole exceeding $1 trillion. And even in spite of the challenges that we had last year, we've still managed to achieve that again in 2020. And in fact, looking at this chart, it's almost as if not a great deal happened last year. The picture looks comparatively normal given the trend that was already in place. Now, what we have seen, though, is because we have seen a large amount of capital raised through a smaller number of funds, obviously that means that the size of average funds being raised is increasing. And that means that we have a a larger number of smaller funds that have yet to close still in the market. So we still have the situation where, yet again, we have a record number of funds in market, and they are typically smaller funds as well, as we'll see on our next slide here. You can see that the average private equity funds in particular, the size of those funds is decreasing. Now, probably one of the most interesting things that we've seen with our most recent data set coming out of Q1 is the boom that we've seen in venture capital valuations across the world. Now, obviously, I think it's becoming a bit of a cliche now, but clearly, since the onset of the pandemic, we've seen a clear distinction between the winners and the losers in terms of companies that are innovating in technologies which have seen their adoption accelerated by the pandemic, and those which are being left behind. Now, typically, of course, these disruptive technologies are typically backed by venture capital firms. So the price for which investors are willing to bid for these companies is increasing. And that's why we've seen a very sharp increase in deal value, despite a drop-off in the number of VC deals being completed in Q1. Now, clearly, I think part of this increase in valuations will be justified because of that, but there are obviously some concerns that pockets of valuations may be getting quite excessive in certain areas. I mean, we saw the SPAC IPO of Grab, the news being announced yesterday. That's a $40 billion valuation for a company that has less than $2 billion in revenue. So a pretty punchy valuation, and it remains to be seen whether or not that is reasonable or not. Now, of course, it's not just affecting deal activity, but we've seen very, very strong exit appetite as well. I think what's interesting to note on this chart is the fact that if you look at the first half of 2020, there was pretty much no disruption when it came to venture capital. This industry adjusted a lot more quickly to the pandemic. Exit activity held up relatively well. This is in contrast actually to buyouts, where we saw softer activity in the first half. That created a pent-up demand which came through in the second half of the year. But actually with venture capital exits, we've just seen a huge surge in the second half as these technology-driven companies have been re-rated. And that certainly continued into Q1. I mean, obviously that's still a pretty strong quarter in terms of the amount of capital exited, but it is obviously a decrease on Q4, as you would expect, because there is at least some element of seasonality in there as well. Okay, so we'll move on to what our LP clients are telling us in terms of their preferences now for emerging markets. Now, if you look at our investor data in Latin America right now, this shows us where the demand is coming from for Latin American exposure. And I think it won't be a surprise to many that most of that is coming from North America and South America itself. There's also a large amount of Latin American institutional investors who are increasingly preferring to invest offshore, but clearly a lot of domestic investors looking to invest in South America as well. Now, again, a very interesting chart that came from our investor survey last year in August. We surveyed investors about where they were preferring to invest going forward. And you can see quite a sharp distinction here between developed markets, which are becoming increasingly developed or increasingly mature. And we've seen a drop-off in appetite for those going forward on a relative basis, but obviously still very strong appetite in absolute terms. But it's the emerging markets that are garnering more interest. We've seen an increase of a very strong increase in emerging markets and Asia Pacific as well. Now that's obviously quite an interesting trend. The key question for us really is to what extent can these emerging markets absorb that capital? Because obviously there remains some quite key structural barriers to being able to deploy capital in these markets. I mean, I think in Latin America, we mentioned in our recent report about the fact that the dominance of tightly held family-controlled companies does make it more challenging for capital deployment, and obviously in APAC we have a different set of challenges for other reasons as well. But it remains to be seen how much of that interest will come through into actual commitments. Now, as I mentioned before, I think probably the largest risk that investors are looking at the moment is particularly longer term inflation expectations. Now, I think a lot of us are expecting some transitory CPI pressure coming off the back of the COVID-19 pandemic. That's to be expected, and that's already coming through in the numbers. But I think a key thing to look out for is longer term inflation expectations, because this is obviously very key to pricing long-term government bond yields, and they in turn are very important for alternatives as a whole, given the fact that low yields will incentivize an ongoing rotation into these asset classes. It will obviously help the performance, the performance of buyout funds, given their financing, and it also opens up the opportunity of continued multiple expansion. We're obviously at high multiples already. I think everyone is clearly keeping a close eye on that. But I think when you look at where public equities trade on a global basis, we're still at levels where we could expect some continued multiple expansion. I mean, just to put things into a bit of context, I mean, the MSCI ACWI index currently trades under 20 times, just under 20 times forward PE. So that's more than a 5% earnings yield. And of course, on the US 10-year, we have in the region of 1.6% still. So even though valuations are high, we may expect public equity multiples and therefore private equity multiples to continue to re-rate. Now, Latin America, as I said, I mean, this is a relatively new region for us. We've just recently released our first LATAM focused report. Now, I think probably one of the largest structural trends that we have seen, particularly in Brazil, actually, so not necessarily the rest of the region, is instability in terms of growth and inflation. And that means that traditionally it has been quite a challenging region for international investors to deploy private capital investment into the region because of that uncertainty. But going forward, it appears that the outlook is quite good, both in terms of growth. I mean, we've obviously had a huge hit because of COVID-19, but the expectations going forward look pretty solid, both in terms of growth and inflation as well. Clearly, I think Brazil is the outlier, of course. There's ongoing structural issues there, but the rest of the region looks in pretty good shape in that respect. So we also asked our fund managers, our fund manager clients, where they see the opportunities presenting themselves in Latin America. The standout point of interest here is Brazilian hedge funds have seemed to have a huge increase in appetite, but a lot of that is down to what we would describe as internal capital flight. A lot of domestic investors in Brazil trying to gain exposure to assets which are not BRL denominated. But aside from that, there's clearly a lot of interest in private equity and venture capital, and also real estate and infrastructure picking up quite a bit of interest as well. Now, this is the data that we have so far on private capital fundraising in Latin America. So pretty steady as it goes, really, despite some of the macro challenges that we've seen in the region. Quite a steady increase in fundraising over time. In terms of AUM, this is how we see the split currently across Latin America, with obviously Mexico and Brazil making up a large portion of the total. And this is how the total has evolved over time. So obviously a clear increase gradually over time, but going forward, we expect that Latin American focused private capital funds will grow at a 11.1% CAGR until 2025. And that's something that we outline in more detail in our Future of Alternatives 2025 report. Now, in terms of the breakdown, we're tracking currently over 250 private equity funds, over 250 venture capital funds, but there's a full range of vehicles there that Preqin is keeping an eye on. and that we have further information on our platform. Now, to look at Latin American deals in particular, again, it's been a relatively steady picture in terms of deal flow. In spite of the challenges, we have had quite steady numbers of deals coming through, but also the aggregate amount of capital raised in Latin American focused deals has stayed relatively steady. And just very briefly, in terms of the breakdown, 2020, we've seen a huge increase in IT and tech deals, which is very much consistent with what we've seen elsewhere in the world. So that's interesting. But the standout asset class that we would like to look at in the region is venture capital. We have seen quite a marked increase in venture capital deals. And again, for the regions that we were discussing before, the outlook for disruptive companies now is particularly bright because we have seen such a strong adoption rate taking place due to the pandemic. We've seen several years of adoption of some of these technology trends being condensed into literally a couple of months in some instances. So that means that the outlook for some of these VC-backed companies is looking pretty good. Again, VC deals by industry. I'll move on to what we see in Colombia. So the most prevalent strategies that we see in alternatives with a geographical exposure to Colombia, there's a very, very good mix here. Real estate opportunistic funds are more prevalent, but growth and buyout as well, as you would expect. There are plenty of strategies there. So again, further detail, in the interest of time, I'll run through these relatively quickly. But if you'd like to look at the presentation in more detail, please do so afterwards. Before we wrap up today, I'm just going to run through a little bit on ESG. We've seen that clearly the adoption of ESG across the globe has been accelerating in recent years. Now, Europe is pretty much ahead of the curve in this respect, but we've also seen accelerating adoption in other regions as well. Putting Latin America into context, this shows that the amount of capital that's committed to ESG currently stands at 44% in the region. So certainly room for improvement, but that's definitely something that has been increasing over time. Now, in terms of, we also asked fund managers within Latin America what they thought about ESG, and it's, again, the adoption is clearly there. We've seen 44% of respondents saying that their ESG policies are in progress, and a further 33% are raising awareness of ESG as well. So that concludes my presentation for today. So thank you very much for taking the time to listen. If you have any questions about the presentation itself, or if you would like to learn further about our data set, please get in touch with either myself or Rebecca Johnson, who is working on our data for the region. If you have any questions about the product, about Preqin Pro, what we can offer in the region, then please get in touch with Fernanda. Our contact details are there. So thank you very much.